the likelihood of contagion happening is quite high. I think the world is just going to be on fire coming up because of liquidity, credit events, currency movements, geopolitics. For the bond market today, your upside is probably 4% and your downside is minus 40. So if this was a table at Vegas, no one's playing this table. It's empty, except for all the suckers and patsies who still think this bond market is safe and secure. And I think Bitcoin is moving towards.
Ever feel like the global economy is going completely off the rails? Yeah, me too. And you are definitely not alone. That's why I brought on someone who's going to help us cut through the noise, macro heavyweight Keith Dicker. This guy is a legend. President, founder, and chief investment officer at IceCap Management, as well as the co-founder and funniest member of Canada's biggest and best economic podcast, the Loonie Hour. Trust me, you're going to want to stick around for what he has to say. Keith brings jaw-dropping numbers to reveal why the bond market is a ticking time bomb, unpacks how geopolitical chaos is quietly shaking up markets, and of course, Bitcoin. Why Bitcoin is staying surprisingly calm despite it all, and a hint of where it may be going next. Going beyond Bitcoin to bring you the skills and insights you need to escape the fiat matrix, this is Mentor Sessions. Keith, thank you so much for joining me today. Really appreciate you taking the time to sit down and share your insight. I wanted to kick things off kind of talking about the bond market and the credit market in particular. One thing that caught my attention is that it seems like both the US and Canada has had this sustained inversion on the yield curve, which I would have guessed would have resolved itself by now. I'm curious, even just broad strokes, what are you seeing in the credit markets? How do you kind of see things progressing?
So, we manage money for families across Canada, as well as down to the US and Europe and Asia and, whatnot. So we tend to have a bit of a different view on markets and what's moving them and what isn't. The short answer to your question on the yield curve, a lot of it is just capital flows. So, an example, you got capital flows moving in. There's always a demand for treasuries and so forth. That's affecting it. You also have, every 2 weeks or every month, everyone is contributing to their pension plan or group savings plan, whatever they're involved with. And that also has a steady flow of capital going into all markets. Just by default, money flows in. So we'll come back to this in a second. But a lot of people are saying, hey, what's going to cause markets to trade off or correct? You get other noise taking place. But the moment we start to see job losses, so negative numbers in the monthly print, whether it's in the US or Canada or elsewhere, suddenly the flow starts to slow dramatically. And it's like a river, it just changes course all of a sudden if you're around something like that. So that's going to have a huge impact on all markets, but including the yield curve. But let's just talk about, our view on the yield curve, not the yield curve, on fixed income markets. Yep. And a lot of this is all tied in together because nothing functions or operates in isolation. And so the first thing to think about for everyone listening is that all markets are either directly or indirectly affected by changes in the 10-year bond yield. And most people know, hey, when the bond yield is going lower, what happens with bond prices?
Going up.
Yeah, they're going up, baby. They're going up. And what happens when they're going lower?
Going down.
Yeah, they're going down. I apologize for the noise here. This is going to be gone in a second. In the 60s, 70s to early 80s, long-term bond yields with a 10-year went from around 5% all the way up to 15 to 20%, depending on which market you're in. And when that was happening, it was a grind for financial markets. So during that period, equities were brutal. I think from 66 to 82, using the Dow as a proxy, it averaged about 2% a year. But you're up 60%, down 40%, down 30, up 20, up 15. Like it was horrific. So if you ever chat with any old guys that are around back then, a lot of them just quit investing in the market. The bond market did a bit better on nominal terms, but it was also a grind because long rates are going higher. And, of course, other things were happening. You have the 60s with hippies, you had, the oil embargo. The dollar came off the gold standard and stuff like that. But overall, overriding everything was this interest rate story. When rates peaked in 1982, then they started going lower in the 80s, the 90s, and the O's, and they hit zero. Yeah. So during that period, when rates were going lower, It was an amazing time to be alive. So, the stock market will always do its thing, but the bond market, especially if you're long duration, it was one of the best investment experiences on a risk-adjusted basis that you're ever going to see. So I managed money for some farmers across Canada, and you chat with these old guys, and some of them would say, hey, they had a tractor loan at 25% in the early 80s.
Wow.
And of course, I say, hey, how does that work?
Yeah.
And, they said, hey, it doesn't. They're literally trying to hold on to the farm. And but then rates started going lower. And then when rates are going lower, all of a sudden, it's easier to refinance everything all the time. So if just say you're in the mortgage world, so you have a 5-year term in Canada or in the US with the Americans, on a 30-year, for example, every year your mortgage rate or your payment is going lower because you have that, lower rate. Same thing for governments. We're going back into governments in a second as well, because I think it's going to be very interesting what happens in that space. But then every time rates are going lower, Nathan, it enables governments to run larger deficits, because at the end of the year, when they have to finance that, it's at a lower rate than it was at the beginning of the year. And plus older debt that's maturing that they have to roll over, that's being rolled over at a lower rate as well. So this happened for the 80s, the 90s, and the O's until we hit zero. And it was 30 years of an amazing experience. And what the industry also figured out during that time frame was that, hey, when you invest in the stock market, whether you know it or realize it or not, you are implicitly agreeing to a performance experience where in any given year you can be up 50% or down 50%. Of course, no one wants to be down 50%, but when it happens, you say, okay, it happens. But the bond market was different. The bond market, you were always between, let's say, 5 and 10% return experience. So the industry just combined the two together. That's what they did. And when they did that, it's really smoothed out the volatility for investors. And then when rates hit zero in 08, 09, all of a sudden they sat back and they said, whoa, we cannot let rates go higher again. Because what happens if rates go higher?
Yeah. Bond prices are going down.
Prices go,
yeah. And we got less coming in.
It's horrible.
Yeah.
And if that would have happened back during that period, it would create a lot of solvency problems for a lot of financial institutions. Pension funds would have really been struggling. Politicians would have lost their jobs, probably. And
good.
No one wants that to happen.
No one wants that ever.
Oh, God, no. Yeah, you don't want that to happen. Those hardworking folks. So central banks, they all cut rates to 0% or near zero or even negative in Europe and Japan. And then they also did quantitative easing. And, some people call that money printing. It's not technically money printing, but it's in the same spirit, so to speak.
Would it be the prevention of money destruction? That's always the way that I kind of framed it up, is that QE wasn't adding additional currency units, but it was preventing the destruction from defaulting loans or of essentially happening. So it's keeping the outstanding currency higher.
Yeah, I don't think it was that depth. There's not much depth to the thought behind it.
Okay.
It was really to suppress the global yield curve.
Yeah.
Because remember 60s, rates are going higher, it sucked. And then 80s, 90s, rates are going lower, it's awesome, and, plus during that time, China and India entered, the WTO. The internet was literally created, a lot of younger people don't realize that then, but it did happen. So that was happening as well. But the overriding theme by all central bankers, because they all chat with each other all the time, was that we can't let rates go higher. So they suppressed the global yield curve for over a decade. And that did a lot of things, of course. It completely suppressed price discovery on the yield curve. So what was the bond market really worth? No one knows, because you weren't allowed rates to get to a normal, period where the price would be discovered. And because every other market is priced off the yield curve, it was sort of one of these, okay, what do we do here? And then, of course, there's lots of stimulus coming on. So you had that monetary stimulus happening. And then that was overlaid with fiscal. By the way, I know I'm lecturing, so just...
No, go.
You're going to bear with it, yeah. But obviously you had all this fiscal stimulus from all over the world. Because the idea was, yeah, we're in a really difficult spot here. Let's try to, like the Europeans said, let's try to grow our way out of this bad loan portfolio crisis that the European banks have. The Americans did the opposite. They said, we're just going to buy it from the banks, this TARP program, and then let the banks slowly heal themselves that way by getting free money. And of course, that also helped governments borrow more money. They could run bigger deficits. Was there a recession? Nope, because it wasn't allowed to happen. And so that continued, of course, for a full decade. So now we have 40 years with rates never going higher. Pandemic hit, all kinds of stimulus coming on tap. And then it was really in 2022, that's when sort of the risk genie came out of the bottle. And that's what makes your world now very interesting.
Yes.
And what I mean by that, in 2022, equities did their thing. They're down 20% or more, but the bond market was down anywhere from -10 to -35%.
Yep.
And this is the market which the industry would tell you it has low risk. It's for the most conservative investors in the world. You want to sleep well at night. And so if you're down 10%, let's say a 2% yield at the time, it takes 5 years to recapture that loss with income. If you're down 30% or more, it's hellish. And that happened because long-term rates went from 1% to 4%, using the US as a proxy. And as we all know, when rates go higher like that on the long end of the curve, it's bad stuff. So back to your first question. The bond market. Again, this is our view, so people don't take this as, Keith said this is what's going to happen. But the industry's expectation for the bond market, it's based on a period that will not happen again. It's over. This previous 40-year period that we had, where rates were always going lower, fixed income strategies, you collect the yield as well as you made money on duration. People move into some spread products when we should have had recessions to eliminate excesses in all markets after 2008 and 9. That wasn't allowed to happen. And it's all been accumulating to this point where we are now. So here's your showstopper for the day. Whereas the equity market, you're always going to be up 50 or down 50%. In our view, and it's not guaranteed, but for the bond market today, your upside is probably 4%.
Ooh.
And your downside is -40. Like that's what could happen here. And if this was a table at Vegas, no one's playing this table. It's empty, except for all the suckers and patsies who still think this bond market is safe and secure. So with that sort of in place, we're now starting to see as well that government deficits, they continue to get bigger every year because they will always spend more money than they're collecting with our taxes. But now suddenly, because inflation is insane, but they're spending even more. And now it's taking more and more tax revenues that's allocated just to pay the interest expense on debt. And because next year the deficit is even bigger and rates are higher than beginning of the year, and previous debt that's maturing has a higher rate. Previous debt has a lower rate than the current rate. It means the deficits get bigger. So in Canada, for example, in Ottawa right now, there's about 50 billion is allocated to interest expense on our federal debt. And they're spending about 50 billion on healthcare back to the provinces. So
Wow.
They're spending the exact same amount on interest expense as they are on healthcare. Interest expense is not a product, is not a productive investment of your capital or
Yep.
your tax revenues. And because now this is increasing at an exponential rate, because rates are going higher, deficits are bigger, and older debt has to get rolled over at a higher rate. The only way out of this for governments right now, with the easy way, they can take losses. That's not going to happen. That's not going to happen.
That's not gonna
Central
happen.
banks won't let that happen either. Or they're going to try to grow the economy faster than what this exponential increase is happening. And because they weren't able to have success with that during, the last decade, so from 2010 to 2020, it's highly unlikely they're going to have success with it during a period where all economies are slowing, interest rates are going higher, everyone's unhappy, they want to go to war for some reason, they think it's good. And so we are into this sort of coordinated risk experience where the probability of something significant happening is quite high in our view.
Are you still delaying taking self-custody of your Bitcoin? Do you feel secure in your current Bitcoin setup? If something were to happen to you, would your stack make it to your loved ones? At Bitcoin Mentor, we've helped thousands of people level up their Bitcoin security and fast-track their understanding. If you find that you simply don't have the time to go through all the books, the tutorials, the guides, you can book a free one-on-one strategy session with myself, Gary, or any of the other great mentors by visiting bitcoinmentor.io. Scan the QR code or simply click the link in the description down below to find out how Ben and the entire expert team at Bitcoin Mentor can help you accelerate your Bitcoin journey.
Use promo code BTC Sessions for 10% off.
And what kind of, can you give me a little more detail on those tail risks? Is there anything in particular that you think is something that's worth paying attention to? Would it be just geopolitical tensions? And even one of the things that caught my attention that I was thinking about where you're going there as well too, is that I don't think there is any way for them to get off of this. And if I think about bond rates, particularly in like the long end of the curve as a combination of like risk, growth expectations, and inflation expectations, it almost feels like the bond market's calling the government's bluff that there's no way you can grow your way out of this. That they don't expect that. Yeah.
Yeah. I always laugh when people say, oh, they're going to grow their way out of the, the debt or inflate of the way, for example. And, I call BS on it because, again, if they couldn't do it with a decade of zero rates, how are they going to do it now with rates are a lot higher and growth is slowing? So in terms of a tail end risk or tail risk that could develop, I think it could come from any specific economy or country. And it's probably going to be a liquidity crisis or a credit event. It won't be a stock market event. The stock market will react to it, of course, but it's going to be a credit event. And what should happen in that environment is that we already know how central banks are going to react. So if you look at what happened with the Brits, I think it was 3 years ago. Remember they had their credit.
The gilt market,
there. Yeah, the gilt market, yeah. You don't feel guilty about it. But it doesn't matter if it happened to the Canadians or the Americans or Germans, French. It's irrelevant. What we know will happen as a reaction, the central banks are absolutely going to run in and do QE to bail out the government bond market. And they have to. Now, I always laugh on, when you get the talking head pundits like what you and I are doing, and people say, well, the Fed should do this or the Bank of Canada should do that. It's kind of irrelevant what you and I feel they should do. Instead, it's way more important to know what are they going to do. We can disagree with it, but hey, we know what they're going to do. So the central banks are always going to bail out the government bond market, because if the government bond market fails, the government fails. Commercial banks collapse because their regulatory capital has to be in government debt.
Yep.
They get penalized for holding corporate debt in there. They have to hold more of it, as an example. So if we know that's going to happen, then we know the risk will shift away then from the government bond market and to go into credit markets. Investment grade, high yield, emerging market debt, for example. But the one market that we feel is going to create some uncomfortable moments will be private credit.
Interesting. Okay.
And the reason for that, because there's no liquidity in it. By definition, if you want to get your money out, if everything is fine, they'll give you liquidity. But the moment things become uncomfortable, they're going to gate it. They're going to close the door. You cannot get your money out. And it's already happened now with a handful of credit funds over the last year anyway. So we're starting to see that. And, there's a lot of dynamics, of course, taking place, public versus private credit markets. The supply is shifting towards one market over the other. But if we do go down to this sort of credit liquidity event, maybe it's triggered, by a major country growing a lot slower, job losses, maybe it's a geopolitical event. It doesn't matter what causes it or where. The likelihood of contagion happening is quite high. We're Canadian, of course, up here. We just don't want Canada to be number one in the G7 with this kind of event. You want to be last. But if it did happen, for example, one of the European guys, it's likely going to hit Canada very, very quickly as well. So in that event, I would suspect that any kind of a credit spread product that you're in or market, no matter if it's investment grade or high yield or private credit, that's probably you're going to see credit spreads just blow out because there won't be any liquidity there, because risk can't get expressed with sovereign debt because central banks are saying, not on our watch, it's not happening here. So of course, if that happens, to say credit markets come down, because remember when in 2022, when the long end of the curve went higher and 10-year or, TLT, that kind of a market, had a minus 30% or plus, credit spreads didn't budge during that year. They were solid.
Yeah, that's crazy.
So we get a period now where long rates move higher, plus you get the credit spreads blowing out. That will happen again. And it's also going to create one of the best buying opportunities of our lifetime, which is not the stock market, or something else. It's credit market. So we get, we're kind of nerdy in that we like to look at that space. And we're not invested in it because we feel, why would we? It's an asymmetrical risk return opportunity right now. Again, your upside is limited and your downside is enormous. We suspect that will flip at some point, and we'll get on again then for another call. And it's just gonna be one of these magical times, to like another thing that, I like to say, do you know how you make 5 times your money in the bond market?
How?
You buy the bonds for 20 cents on the dollar.
Yeah, okay.
I don't know if we go to 20 cents, maybe it's 60 or something, but that's the kind of, and if that's happening, of course, from an economic perspective, there's job losses. Yeah. And that's going to create some uncomfortable moments, but everything is set up for this to happen because the whole world has been relying more and more on debt financing at lower rates all the time. And we've clearly hit this, the trough. Now we're going higher. You mentioned Bretton Woods. I know recently everything agreed to during that period or era, it's either it's over or it's become highly ineffective. It doesn't work anymore. Like the IMF, for example, who can they bail out today?
Yeah,
no one important, really. So it's this whole setup. It's incredibly interesting and exciting from an insensitive perspective.
Well, it's definitely exciting and from an insensitive perspective because a lot of people are going to lose their jobs and a lot of what they think is their savings as well too. And so kind of teasing that out a little bit, I'm curious your thoughts then. So if the government is going to have to step in, fiscal spending is going to continue to increase over time. The government is going to have to step in and essentially monetize the debt, buy up the sovereign debt. I'm wondering how you think that plays perhaps into hard assets in particular. So I don't know if you've seen like Brent Johnson's view on the dollar milkshake theory. I kind of think that he does have a good argument there. And I could foresee something like both Bitcoin and gold and USD all rising together as other fiat currencies struggle.
Yeah, I agree with you, Nathan. Yeah, absolutely. And in terms of like monetizing the debt, they don't see it that way. The central banks, for example, they just see it as, hey, of course they are monetizing the debt. So in Canada, for example, during COVID, I think it was 92% of all debt issuance back then was purchased by the Bank of Canada.
Yeah. Yeah.
So
wow.
If that's,
okay. Yeah.
They failed. They didn't get 100%.
Yeah.
So yeah, again, I don't want, the listeners and viewers to think, yeah, they didn't monetize. They absolutely did monetize the debt. The main goal though, is to make sure there's still liquidity in that world. So governments can then spend it, and they can't control what spending is. Spending is if you look at Canadian productivity data, it's horrible.
It's bad.
Yeah. If you look at the percentage of the economy that the government is relative to the private sector, the government share has been increasing year after year after year over the last 10 years.
I saw 21.6% of like employment is public sector employment in Canada, which like more than 1 out of 5. That seems unbelievably
wasteful and inefficient and going to cause a lot of problems.
Is it that high, really? Is it?
Yeah,
really?
it's been going up ever since, I think 2019 was kind of the bottom there with COVID.
Yeah, it's tough, right? And like with productivity, I have a lot of friends, they work for the government in different capacities. And, sometimes they hear me, drone on about productivity from government workers isn't good. And they say, hey, I work hard. And I say, yeah, no doubt you work hard. But for every dollar that goes into your salary, the multiplier effect into the economy, it's much lower than the dollar that goes into the private sector to create a job. The multiplier effect is higher. And, we just happen to reach, so with Bretton Woods, it's an 80-year cycle that's over.
Yep.
Then we're at the end of a 40-plus year cycle with rates, peaking in 82 and then coming down. We have this debt cycle that's been, it'll keep going because it's, I don't know how they're going to, if they stop spending, the economy collapses.
Yep. Right?
That happens. So then by default, we talked about the deficits that are taking place for Canadians as well as the Americans, the big, beautiful budget and all that. And the Europeans. Now, everyone in NATO wants to spend 5% of their budget on military, right? They refused to do 2% 5 years ago. They wouldn't do that. Now it's under up to 5%. But I suspect all major governments are going to come out with a fiscal bazooka. That's what I would call it later this year. Maybe it'd be very dramatic if they all did it in the same day. That's a great way to goose the market. They won't be that coordinated with it, but we should expect enormous deficits coming out, which means more government borrowing, more government involvement with investing or spending in our economies. Some of it will be good. Some of it won't be very good. But it's just going to continue to push us towards this point in time where something, it'll break or snap. And when that happens, some part of markets should do very well. You mentioned some of them earlier. And, I think that's going to create a lot of opportunity.
No, I agree. And I imagine it'd probably be like a correlation event too, where everything's down and that's your chance to get in there and scoop something up. For me, that'd be Bitcoin, just lots and lots of Bitcoin. I'm curious your thoughts. Absolutely. I'm curious your thoughts on, how do I phrase this up? So I think there'll be continued tensions, both culturally and kind of like across the US and across Canada within the country as well too. I would imagine if they're going to come out and do major fiscal spending, that money is ultimately going to flow into assets, and you get that further kind of economic divide between people who own their home and have savings and have companies and things of this nature too, which would further escalate, resentment and kind of issues in that sort of sense. Combine that with, I think our population is only growing at like 2% right now. And I'm curious on this too. If it almost looked to me like we almost had like a human QE in Canada, that we're just bringing in more people in order to prop up the economy and try and get additional growth by just literally bringing in more labor supply. And that seems to be going a reverse trend right now. I'm curious if you have any sort of framework or ideas of how like tensions within countries might continue to escalate as a result of this, and if that might even be a boiling over point. There might be an issue there. The example for me, I'm in Alberta. If the economy gets worse, I think that further adds to the Alberta independence kind of sentiment that we see growing here.
Yeah, I had my condo lined up to buy in Canmore, by the way.
Good. It's beautiful. You're going to love it.
Oh my God. I have a lot of love for Alberta. Yeah, absolutely. And so I'm in Nova Scotia. We are the highest taxed province in Canada. Yeah, it's unbelievable. So keep the door open for me if you go that route. We'll go there. So with that, question, Nathan. So first of all, the Canadian economy has only been growing on an aggregate level because of the population growth and debt growth. So it's taken more and more people and more debt to produce the exact same dollar of GDP. So that in itself, that is a definition of declining productivity, if you're into that, wonky world of economics. The Canadian population growth story, we've now gone to 0 in Q1.
Is it that low now? I thought it was like just sub 2%.
No. There's a lot of confusion out about that over the last couple of weeks. And we're basically at zero right now. And the Bank of Canada, they are overstating the population growth. And once they get a better idea what it's going to be like, this is an anchor for the economy. So that's why we feel like the fiscal bazooka is going to be even bigger.
Yeah.
Why? So like in Canada, what's our deficit now? Nobody knows.
Yeah, they didn't put
haven't
a
had
budget.
a budget for over a year. It's insane. And, they talk about, we're going to attract all this foreign investment to come in for the energy sector and everything. I say, that's bullshit. I mean, if you are an investor, the first thing you ask to see, I want to see the books. Show me your balance sheet. Especially show me your income statement. Who created it? Is there an auditor involved? Everything. So, government will always spend stupid money. But the private sector, we don't like to lose money. That's not what we're in the business of doing. So if you're trying to decide right now to allocate, say, $500 million to the Alberta energy sector or 500 to an equivalent opportunity in the US, I would imagine the US is getting that money right now 9 out of 10 times. Because there's so much confusion in Canada, what's going to be accepted, what isn't, and stuff like that. So if you go down that road, with no population growth and the economy is slowing, that's absolutely going to create resentment amongst different demographic groups in Canada, especially the big cities as well.
Yeah.
And but of course, the oldest playbook, the oldest trick in the book is that when you have a domestic challenge, you always find an external enemy to blame.
Yep.
So for our election, of course, who was the external enemy?
It was Trump, which I got to say, that was beyond frustrating. I thought after everything that had happened during COVID and after the fact that we may have been coming up on to, what would I call it? The, I think it was Professor St. Ange, the pitchfork moment. I thought that Canadians must have been fed up at this point, but you're right. As soon as I gave him Trump as a target, they'd forgotten everything that was happened, and they were all, elbows up, buddy. We got to go after the big mean orange man.
It was, it is what it is, and in some ways, you have to respect the Liberal Party in Canada for having the best campaign strategy. Yeah, really the only one they can come up with to win. And then you had the Conservatives. Either they didn't anticipate it or they didn't react fast enough, but they were trying to campaign on what I will call the real issues. The real issue wasn't Canada becoming a part of the US. That was never a challenge whatsoever. But hey, that's where we are now with it. But it is a good example that when you have a challenge domestically, just find an external enemy to blame. And that brings us to, the whole geopolitical world. And seemingly, politicians, they all want to go to war. And I think before any government, votes or agrees to go to war, they should have to go to the front line on day one.
Yep.
See what it's like, because I have a son
sign up your kids.
Yeah. I said, hey, by the way, if there's a war, you are not signing up for any of this stuff. He said, don't worry, Dad. No chance that's going to happen. But there will be a lot of families that will go. So now if countries are now increasing their I guess investment or budget towards NATO with a 5%. So for Canada, that's 150 billion a year that we'll be spending. And I bet you right now it's probably 10. It's minuscule, and a lot of that is going to go, hey, we, not only is it trying to, build new boats or equipment and stuff like that on the technology side. They want people. They want people to do this. And, you get some people young people, they can't find a job and, they get recruited on the street. Yeah, free education and stuff. A lot of people will go into that. And that's how you sort of replenish the war machine. But Canada's going to do it. All of Europe is doing it. The Americans, everyone else. So it's, I don't like where this is headed, because it doesn't mean it has to happen. But if everyone is spending more money on a war machine, they're going to want to use this machine. And anyways, it's not going to be a very pleasant experience. I don't have to worry. I'm old and slow, blind and deaf and everything. But you look fit and strong. You need to hide out there.
I was gonna say I ended up throwing a couple more pounds and make it so that I am not eligible anymore. No, I agree.
I notice your back is kind of tweaking you. You're not able to
I just can't get comfortable here. I need a new chair. It feels very fourth turning-esque vibes, right? It feels very fourth turning that we're coming into something. It could be geopolitical, no idea. It could be just a major credit crisis. But something's going to happen. And even kind of on that note as well, too. And then I promise I'll bug you about Bitcoin because I have to do that and I want to get your thoughts on it. But do you foresee, not necessarily the sovereign debt side, but I know they're closely interlinked. Do you foresee any currency crisis anywhere in the world? So do you see, and specifically where would that be? Because I wonder, I feel like Canada and the US are going to further deviate. Like I think it looks like they're doing a little bit better right now. It looks like Powell's been able to hold rates higher. I do think we have some cuts on the horizon. I wonder if he's just going to kind of ride it out to the end of his term. So he can just say, I did it. No one thought I could do it and get out. And the next guy will just rapid cut. But I'm wondering if you see any currency issues around the world. And one thing that caught my attention recently was actually the Swiss franc. Because they've gone back down to zero, but their currency appears to be at an all-time high, or at least really close to their all-time high. And that seemed like a weird signal to me.
So with the Swiss franc, or the Swissy that we would call it, people have to realize Switzerland is not the same country that it used to be. Because it used to be this place where, you can not hide your money, but reallocate your money so that it was
obfuscate.
It was confidential. And of course, they gave all that up to Americans maybe 15 years ago, 10 years ago now, almost. The economy, they are a net exporter. So it means they always have foreign currency coming in, which means they don't have to issue a lot of debt. So the supply of Swiss franc government debt is not very big. So if you want to buy Swiss francs, you are in effect buying the Swiss debt. Just like if you want to buy US dollars, you might think you go to the bank, they give you US dollars, but you need it's really the debt market that you're looking at. The Swiss franc is really, it moves as a proxy with euro. And because the Swiss, they are an exporter, they want the currency to be, somewhat weaker. They're lowering rates to offset any rate cuts by the ECB.
Yeah,
that's why they're close to zero. They're saying, okay, if you want to buy our currency, you can, but you're not going to get paid on it.
Yeah.
So I wouldn't put for us, we love the currency world. I think it's amazing. It's all capital flows. I wouldn't put a lot of weight on what's happening in sort of Switzerland as an example. But when it comes to the currency world, so back where we mentioned earlier that, you get QE forever by the central banks to bail out some of that, risk has to get expressed somewhere. Foreign capital that is liquid and is mobile, they can move around, it will always run away from trouble. So whereas the industry tells you something bad happens, oh yeah, hang in there, pal, for the long run and you'll be fine, sucker, that's what they'll say to you. The really wealthy guys were smart. They run away from trouble. I don't need to fight this monster. And when they do that, they need to find some market that's really deep and liquid. Something where you can park 500 million, 5 billion, 50 billion, right? That's the kind of capital flows that will come. And there's only one market that's big enough in the world to absorb that kind of capital. And that's the US dollar, which is the treasury market. So you and I, we can park 50 billion in the US market, while we're chatting here, and this afternoon we could sell it again. We're not going to move the price, more or less. You can't do that in Canada. You can't do it in Britain, definitely not Japan or China, you name it. So when we get one of these events taking place where it's, oh, wow, this doesn't look very comfortable. It's not guaranteed, but the probability of the US dollar catching bid and going straight up is very high. So when it comes to the currency world, when things are bad in general, the dollar does very well. And then you look, hey, who isn't doing well? It should be like dominoes, one after the other. Of course, one of the greatest short opportunities that will come in our lifetime will be the US dollar. But
interesting.
But at that point, using the DXY as a proxy, it could be at 150 at that point.
Yeah.
So everyone in the world is saying, hey, do you have dollars? I want dollars. So everyone wants dollars. And that's when okay, it's now the dollar's turn to have their moment. So it's not that the US looks, it doesn't look very good on an isolated financial perspective. It looks horrible. But it's a completely different debt market, completely different currency, the US euro dollar entwined with it and so forth. So, for us, we expect to make money on the currency side on the dollar during one of these events.
Yep.
And it's not a long, it's not something that's going to last forever. But the other currencies are ones that are more at risk in the beginning.
Interesting. Yeah, I guess at that point, every other central bank would be knocking on the door, begging the Fed to try and push the dollar down because of all their dollar-denominated debt outstanding.
But first of all, the swap lines will be open.
Yeah.
That's for certain. I suspect at some point soon. If the Americans are using tariffs as an economic weapon, you're literally counting the days until they figure out, hey, the swap lines are also a weapon. Europe, you're not going to play ball with us. We're going to remove you from the swap line lineup. You're gone. And then you see how fast, they will get in line. So it's really interesting where it's headed.
Very cool. I know that I want to be respectful of your time. I did want to get a couple more things in if I can. First and foremost, I want to ask, what are your kind of views and your outlook for Bitcoin? How do you think about it, if at all? And I'm wondering also, I found it very interesting over the recent geopolitical tensions that the price didn't move nearly as much as I would have expected. And I wonder if, because it's a 24-hour market, but it's not very liquid, like it's smaller compared to something like the treasury market or the real estate market, if you find any signal in those like Sunday night price up and down movements.
Is this the part where I say buy Bitcoin now?
That's exactly it. If I could get that a few times, that would be wonderful.
You're not going to clip that out and put it on there. We're pretty pragmatic about all markets, including that world. So the interesting things with that market, it's becoming more liquid by the day and bigger by the day. So that's positive. It's attracting a lot of attention. And it's moving away from just being retail investors to more institutional-like. So that's great. So we invest in probably 6 different markets we invest in. We look at markets. What is how is it moving during a crisis moment, and what is it more correlated to? And correlations are not constant. They're always going to be moving up and down, and maybe things can change tomorrow that will affect the correlations for a long time. But really, the market has been moving in line with tech stocks with the Nasdaq. If you overlay one over the other, you have that there. So really, that market, it's a market that has high volatility, and it has a lower correlation to maybe broad equities and other markets. So you can get some benefits from that with it. But at this point in time, so we just had to, whatever you want to call the Israeli-Iranian war, whatever you want to call that. It was definitely war, of course.
Yep.
But which markets did really well during that? Where did money flow into? And it was gold and the dollar and oil.
Yep.
Right. That's what happened. Since of course, it's what's this Wednesday? It's resolved apparently. I don't think it is.
We'll see.
Give it a few hours and it won't be resolved. And then we'll see that reverse. But that's what you want to look at. So for for example, for gold, for a long time, people say, oh, it's there to protect you against inflation and stuff. And that's wrong. That's not true at all. Because, gold was basically flat for about 20 years almost. And inflation was moving. And of course, inflation is also measured with real assets as well. But gold will protect you when you have, conflict or weird, crazy things happening around the world. And I think Bitcoin is moving towards that. But we just saw that it's not quite there yet.
Interesting.
And I think a lot of it is the liquidity side of it as well. So if you have an allocation to that market as well as your equities, and equities start going down and you're levered, like, oh boy, I need to reduce my leverage, by default, you're selling this as well. Remember, everything is connected here in the world. So again, we're not lovers or haters of any market. You should always like or dislike a market. And I love how that market is growing into an opportunity from a risk perspective. But I wouldn't view it as something you buy and hold forever and that's it. If you do, just make sure that the allocation that you're making, it makes sense with the rest of your portfolio that you have. That's the way that we view all markets. So again, I think there's going to be a lot of rock and roll coming up. And if you like that market and it comes off because of liquidity, maybe that's an opportunity for you to add even more to it. If you can scrounge up more money elsewhere, when you're doing it. But I think the world is just going to be on fire coming up because of liquidity, credit events, currency movements, geopolitics, and all this stuff is happening. And the main expectation we have is with the bond market and, the most conservative, risk adverse investors in the world, they're likely sitting on a strategy that's a lot riskier and is not conservative than what they've been told or will expect. And they're the ones that will have an uncomfortable moment. Whereas, you're in Bitcoin or you're in, equities or something else. Hey, you're in that world, right? You're going to go up or down, 10, 20%. It's these other guys. And chances are they're your parents and stuff. So unless you want your parents moving in with you, or maybe you're already living with them, it's going to have some weird dynamics coming up.
Agreed. Keith, if I can, I'm going to just squeeze in one more quick question. I'm just curious if you have any thoughts on the recent passing of the Genius Act in the U.S. as it pertains to U.S. stablecoins. And the reason I bring it up is it seems to me like that's another potential buyer for U.S. debt in particular. They've got these companies that are buying up short duration bonds and then basically selling casino tokens for a U.S. dollar, that it's opening up the world to more of it's opening up like the world's small retail audience to basically buying more T-bills. And it feels like another way to continue kind of kicking that can down the road. I've wondered if this fits into your framework at all, or if you have any thoughts on that.
Yeah, I don't have a lot of thoughts. I'm an expert on a lot of things. That isn't one of them, but it is something that we're following closely. And so that's all I can share with you on that side.
Perfect. That sounds good. Well, with that, I look forward to seeing you in Canmore when you eventually move your way out here. And I hope you have a wonderful day. Do you go to Canmore
very often?
I will be out in Banff this weekend. I'm like 30 minutes from it. or 40 minutes if I'm driving the speed limit. I'm just west of Calgary here.
But it is a nice part of Canada. Absolutely.
Before I let you go, where can everybody follow your work, find you, check out your stuff? Give me all that good, all the good links.
Yeah. So the great stuff is on X. It's at IceCap Global. Our company is IceCap Asset Management. And I also, I'm the co-host of one of Canada's most successful macroeconomic podcasts called the Loonie Hour. You can find us as well in that world.
If you enjoyed this episode with Keith Dicker, please do like, share, and subscribe, and check out the previous episode with Derek Gaunt on mastering negotiations.